Hi, and welcome to Vested InTrust, Smart Investments for a Better Future. Today we will try to answer one of the most important questions in the field of personal finance. What should be our minimum time horizon while investing in equity-based mutual funds? Equity-based mutual funds are those mutual funds which invest in stock market. As you guys know, stock markets are risky. But what is risky? How do we define risk? Risk in financial domain is measured by volatility, standard deviation to be very precise. When we say stock markets are risky, what we actually mean is stock markets give volatile returns. You could double your money, you could triple your money, or maybe you could lose all of your money. On one hand, we have fixed deposits where the returns are highly predictable. You are 99.9% sure what your returns are going to be from fixed deposits. But on the other hand, we have stock markets where you can never really be 100% sure what your returns are going to be. But does it mean we should not invest in stock markets at all? A big no. Equities can be highly rewarding in the long run. But how long are we talking about? If not 100%, can I be 99% sure that I will not lose my money in stock markets if I stay invested for, let's say, 2 years, 3 years, or maybe even 10 years? What is the minimum time horizon which will guarantee me that I will not make a loss in stock market? Let's find out. Now, before we begin, we need to understand these few financial terms. If you are already familiar with these terms, please feel free to skip next 2 minutes of this video. Let's begin with equity-based mutual funds. Now broadly, there are two ways to invest in a company. The first way is called debt investment, wherein you actually give the company a certain amount of loan and the company agrees to pay you back the interest every year till a certain period of time, and at the end of that period the company will repay the full amount. The second way to invest in a company is by actually taking ownership in that company, which is known as equity investment. For example, when you buy one share of Reliance, you are actually buying 0.000000001% of Reliance. It's a ballpark number, but you get the idea, right? If you buy certain number of shares of Reliance, let's say 30 million shares, you could actually own 1% of Reliance. Now, debt instruments are considered to be safer than equity instruments. Why? Because companies are liable to pay debt holders first. They have to pay off their loans, and if any profit is remaining after paying off the debt holders, that profit will go to equity shareholders. Now, the mutual funds which invest primarily in stock markets are known as equity-based mutual funds, and that is precisely why the returns given by these mutual funds are highly volatile. They usually track the Nifty 50 index. Nifty is an index of top 50 companies listed on National Stock Exchange. Now, in my upcoming videos, I'll be talking a lot about the internal functioning of stock markets, how mutual funds work, what is Nifty, what is Sensex. But for the purpose of this video, let's stop it here only. Now let's jump to annualized SIP returns. SIP stands for Systematic Investment Plans, wherein you invest a certain amount of money every month at a particular date into the mutual funds of your choice. Now, in order to compare the performance of our SIPs, we need to annualize the returns. Let me show you an example. You have three investment options. Investment 1 will give you 5% return in 6 months. Investment 2 will give you 6% return in 12 months. And investment 3 will give you 20% return in 2 years. Now, can you tell me which investment option is giving you the maximum return? Annualizing the returns basically means finding out the rate of return that this investment option is giving in 1 year, regardless of the overall tenure of this investment. In my upcoming videos, I will teach you how to annualize the returns. But for this example, the numbers come out to be 10.25% for first investment, 10% exactly for the second investment, and 9.54 for the third investment. Now, clearly, going strictly by the annualized return, we have a winner, and that is option 1.
Alright guys, with that being said,
Let's jump right into our analysis. This is the dashboard that I've created for the purpose of this video. It is an interactive dashboard where you can actually highlight one metric at a time, and you can also play with the date filter here. This dashboard is publicly available on tableau.com, and I've posted the link in the description of this video. Please feel free to check it out later. Let me now explain how to read this graph. So I have selected 1 year returns for Nifty for past 16 years. So this blue line is showing me historical returns with only 1 year investment horizon. What it basically means is you start your SIP today, you continue for 12 months, which is 1 year, and then in the 13th month, you stop your SIP and withdraw all of your money. In this scenario, what is the rate of return that you are going to get? That is being shown in this graph by this blue line. For example, let me select June 2014. So it is showing me that in June 2014, the 1 year return was 47% for an SIP. If you could go back in time, start an SIP in June 2013, continue for 12 months, and then withdraw all of your money, your returns are going to be 47%. Now that you understand the graph, please take a look at the overall structure. See how volatile it is. Sure, you can have some years where you will make great returns like 104%. But see, there are so many years where you would have made negative returns. Minus 64%, minus 50%, minus 45%. So when we invest in equities, having only 1 year time horizon is a strict no-go. You can see there are so many years where this investment strategy has given negative returns. Let's take a look at 3-year returns now. Slightly better and slightly less volatile, you can see, with lower highs and lower lows. It is often said that if you want to invest in equities, you should have at least 3 years of investment horizon. But as you can see from this graph, even 3 years is not going to do justice to you. There are so many years where having a 3 years investment horizon will give you negative returns. For most of the years, having a 3 years investment horizon is a good enough strategy. There are so many years where the returns are greater than 0, and if we compare with the FD line of 7%, there are indeed many years where these returns are going to be better than fixed deposits. But see, minus 15, minus 20%, these returns are very brutal for your portfolio. You go ahead and you invest your hard-earned money into mutual funds, equity-based mutual funds, I mean, and you have the patience to stay invested for 3 years. Your investment advisor must have told you that 3 years is the perfect investment horizon. But still, if you end up getting minus 20% return, that is a strict no-go. You can definitely see a pattern here. The 3-year returns usually go below 0 whenever there is a major recession. During this period, we had the famous financial crisis, and it is going negative during this time, which was due to the coronavirus pandemic. Let's summarize with the help of an example. Let's say you have your marriage coming up in 3 years, and you want to start an investment plan wherein you will invest a certain amount of your salary every month into a mutual fund. It is best to avoid those mutual funds which invest 100% into equities. Maybe you can go for those mutual funds which invest, let's say, 30 to 40% in equities and rest into debt. That way you can be assured that even if there's a major recession coming up in next 2 to 3 years, your investment will at least give you the returns that are given by fixed deposits. On the other hand, if things are pretty great, or even if things are pretty normal by the time you liquidate your investments, you are going to get decent returns like you see here. Let's take a look at 5-year returns now. So till now we have established that for 1 year you should definitely not get into mutual funds based on equity, and for 3 years you should definitely not invest 100% of your amount. Maybe cap your investments at 30% of your total amount into equity based mutual funds. for 5 years, you can see there are hardly any years where you are actually getting negative returns. Even during the bottom of 2008 and 2009 crisis, you are getting at least 3 to 4% return. Now 3 to 4% might sound very less, but keep in mind you are going through a recession that comes once in decades. Even in such kind of recession, you are actually getting 4 to 3% return, which is great. And obviously it is not advisable to liquidate your investments when market is at all-time low. You see, the returns in January 2009 are 3%, right? So with 5-year horizon, that means you must have started your SIP in 2004, hoping that by the time you liquidate your position in 2009, you will get good returns, because 5 years is considered to be a good investment horizon when it comes to equity. But come 2009, you see there's a major recession going on. Markets are at all-time low. If you are able to hold on to your liquidation for just few more months, you will see that from 3% return in January 2009, you will get to 18% returns in May 2009. Basically, if you hold on your liquidation for just few months, even 4 months, you will get great returns. So to summarize, the point that I'm trying to make is 5 years horizon is a decent enough time to invest into equities, and by the 5th year, if you feel markets are at all-time low and your returns are not more than, let's say, 7 to 8%, maybe you can hold on for a while. And if you have alternate sources of funds, use them. You must liquidate your position only if there is no other option for you. That is why it is better to keep an 80% cap even with 5 years horizon, so that 20% of your amount will actually stay invested into debt instruments, and debt instruments usually give better returns when equities are down. Now quickly let's take a look at the 7-year returns. So as expected, with 7-year time horizon, I don't think there's any year where you are actually getting zero returns. Even during the coronavirus pandemic, the minimum returns that this investment horizon has given is 1%. And most of the time this line is actually above the fixed deposit line of 7%. To summarize, having a 7-year horizon looks much more promising and much less risky as compared to 5-year horizon. Let's take a look at 10-year returns. Wow, so having 10 years horizon actually will never give you a return which is less than 7%. Okay, so we do have an exception here in the March 2020, which is obviously due to COVID-19. But to remind you guys, COVID-19 is a once in a century event. I don't think we are going to see such event again in our lifetime. This graph is clearly suggesting us that if we have an investment horizon of more than 10 years, then surely we can go 100% into equities, obviously subjected to your risk tolerance. Now I want you guys to focus on the table below. This table will actually summarize the results and help us find a winner amongst all these contenders. Let's analyze each metric one by one, starting with average return. If we go by average return, then the winner is 5-year returns. But all in all, we can see there is not much difference. We did see 10-year returns were relatively less risky, but as you can see, they do provide a slightly lower average return. So that's a kind of trade-off. High risk, high reward, low risk, low reward. Welcome to Finance 101. Now let's take a look at maximum return. Here obviously the winner is 1-year return, but we are not interested in actually maximum return, because to get a maximum return out of equity with only 1-year time horizon, you just have to be plain lucky. I don't think retail investors like us can actually time the market so well that we end up having 137% return within 1 year of investing. Instead, let's take a look at minimum return. You see minus 64%. Nobody wants their investment to go down by 64%. Here, the winner is 10-year return with only 4.7% of lowest return. Now, as I told you, risk is measured by standard deviation. We want this metric to be as low as possible, and again, 10-year is the winner here. So now we are facing a dilemma. How do we decide the ultimate winner here? The answer lies in the ultimate metric, risk reward ratio. Reward stands for average return and risk stands for standard deviation. So we are basically dividing the average return with the standard deviation, and we want this metric to be as high as possible. Let's take a look. Alright, so we have a clear winner. The reward to risk ratio of 10-year return is actually 3.5, which is almost twice of the next best contender, which is 7-year return. This ratio is exactly increasing in the same order of increasing time horizon. This actually proves the proposition that equities are highly rewarding in the long run. So guys, to summarize one last time, the point that I was trying to make in this whole video was that you should not get into equities if you want your money back within 1 year. And if you are looking at 3 to 5 year horizon, don't invest more than 50 to 60% into equities. And if you are having 7 to 10 years horizon or even more than that, then obviously you can go up to 100%, but still it depends on your risk tolerance, it depends on your age, it depends where you are on your investment life cycle, it depends on market condition, it depends on a lot of things. So please take professional help if required. This video was made purely from educational point of view. I will make a video in future where I will actually explain how to find such funds which invest a part in equity and a part in debt. So please stay tuned to this channel. Let me know if this analysis was any good to you. If you learned anything new from this analysis, please let me know. Like, share, subscribe. This is my first video ever and I spent a lot of time in coming up with this analysis. I hope you like it. Thanks guys. See you soon again. Hope you make smart investments for a better future.